So, hey guys, in this episode, I'm interviewing the CEO of Bates Capital Group. His name is Sam Bates. Sam started his real estate journey back in 2009. Probably not the best time to get started in real estate, but he's been directly involved in acquisitions, repositions, dispositions, and sales of over $200 million in assets under management. Currently is a general partner and limited partner in 1,035 units in Texas and in the Southeast, and has another 900 units in his development pipeline. And also, interestingly enough, actually off camera after the recording, Sam told me about a deal that he bought for $16 million. They put a couple $1 million into it, and it actually just got a valuation of $32 million. You actually won't hear that on the recording, but really cool stuff. In this interview, Sam and I talk about, number one, build-to-rent communities, and why build-to-rent communities are satisfying the need for renters, and how he evaluates build-to-rent communities, not only for multifamily, but single-family build-to-rent communities. That's an interesting conversation. Also, Sam talks about, number two, why it really makes a lot of sense for investors to start as a limited partner and make an investment in a deal in a general partner and use that as a way to catapult into the general partnership. Number three, we also talk a lot about property management and asset management and how to oversee investments. Number four, why we're becoming a renter nation in the United States and why we're so bullish on multifamily and syndications, even when it appears that the Fed's going to raise interest rates, even when it appears like the economy may be tapped out, why we're so bullish on apartments and multifamily and build-to-rent communities. So I really think you're going to enjoy this interview on Accelerated Investor with Sam Bates. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Sam, listen, welcome to AI. Welcome to Accelerated Investor. Thanks for jumping on.
Yeah, Josh, thank you for having me. I'm excited to be your guest and just talk to your audience. Awesome.
Sam, listen, there's a lot going on in the South. I know you primarily syndicate and operate in the Southeast, Texas, and down in that area. So I'm curious to see what kind of projects you're working on right now. What are you excited about for 2022? And kind of where do you think the market's going right now?
Yeah, we have a lot going on and very excited about 2022. I've done about half acquisitions and half developments. And with the market being so hot right now, I don't know if we'll have any acquisitions going on, but we have 900 units of development lined up in the pipeline. So that's going to be really exciting, mainly in the Dallas-Fort Worth area, but we also have a project in Austin. And we're going to start construction on all those units this year and next year. We're in different phases of the planning and zoning and raising funds and things like that. So I'm very excited about that. I'm excited about, we just exited 4 or 5 deals. So we provide our investors some phenomenal returns, and we're going to have, I think, a lot of repeat investors. We're able to do some 1031s into the new projects. So there's a lot going on. I hope to get some acquisitions, but where pricing's at right now, it's just hard for me to buy something at a 3 cap in a 1970 or 80 when we can build it for as a 7 or 8 cap. So
got it. Yeah, new construction, wow, at a 7 or an 8 cap, especially with rising rents. It almost feels like, remember in 2006, 7, and 8, when people were like building spec and you'd be all in for 500 grand on a condo, and then it would be worth 800. It's a little bit like that right now. And I think it's going to stay that way for a while with rents, right? You maybe, do your pro forma and the rents are 1,500 a unit. By the time the thing is built and you're leasing up, I imagine those rents are much higher than even you probably pencil out.
Oh yeah. I've always underwritten conservatively, and usually in rent growth, we pencil 2 to 3% per year, depending on the market. And like last year, we bought a deal in Atlanta in January of last year, and we've increased rents by $500 on average. And there's just no way you can project that. Or if you can, no investor is going to take you seriously. So it's really hard, but like I've been watching a lot of the 22 economic predictions and talks, and like last night I was looking at one where the top 10 rental growth rate markets, they're projecting 6, 7, 8%. And in pro formas, I'm not going to do that, but in order to get a deal, I think a lot of people are having to do that, which that concerns me, especially for the new syndicators that don't have experience and maybe not know how to navigate treacherous waters, or just people that haven't went through that, the correction, or they haven't had any storms come about at this point.
Yeah, it's nice if you can underwrite conservatively and then outperform right away.
Yeah.
It's another thing to depend on that outperformance, right? Just to hit your numbers. I mean, you know, there's so many deals, especially the deals in the major cities like Chicago or San Francisco or Atlanta, Dallas, Austin, some of the ones you mentioned that are trading at 3.5 caps. But if you're investing for cash flow, right, just by raising rents, it could easily go to a 4.5 cap or even a 5 cap within 12 to 18 months. Still pretty lean cap rates, right, to be in those markets. So, you know, what are some of the things that you've seen people do or that you've done? Are you guys focused on secondary markets, tertiary markets that maybe there's a little bit more cap rate? There's a little bit more yield between cap rates and interest rates, or a little bit more yield between acquisition cap rate and your stabilization cap rate. Obviously, there's so much institutional money seeking yield, especially in downtown urban areas. It's tough for even someone like you that's get 200 million of AUM and, you know, 1,000 units. Man, to find a deal in those urban markets is really tough. So is part of the strategy to go to those second and tertiary markets?
Yes, it is. And like you said, it's really tough to get them in the true primary markets. Honestly, all of our acquisitions, except the last one, have been in secondary and tertiary markets. The last acquisition we did was 110 units in Dallas proper. But besides that, the closest we've been to major MSAs, probably 30 or 40 minutes out. Some are 2 hours out. And you do have that spread. Now the cap rates are compressing even in those markets. But when we were buying, you definitely had a spread that gave you some cushion. In other ways, we've hedged against that is just most of the debt we've put on has been long-term debt. So if we can cash flow, no matter what, if we have a 7, 10, 12-year piece of debt on it, we can weather kind of any storm. And I started off as a limited partner, and I went through that experience where we had to sell, where it wasn't optimal. And that's always just been something, a takeaway I took, where you want to have that long-term debt. Obviously you might struggle with prepayments or some other things, but I feel like it's better to be safe than sorry.
Yeah. Some of these guys doing bridge loans that are just 2 years, 3 years is trouble, right? At least even if you have 5-year money, seems to be fairly safe. Certainly the 10, 12-year Fannie Freddie or even longer term CMBS stuff, you know, is even longer. But yeah, I agree. Look, you only lose money in this business if you hit a recapitalization event and you're forced to sell or refi. Otherwise, you can weather the storm. You know, you can change up the structure. You have that kind of thing. But if the bank's breathing down your neck for payoff, it becomes a real hard time. And that's why everybody got busted up in 2006, 7, 8, 9. And, you know, I don't forecast that now. I think we're in a different space right now. There's just a different world right now. There's so much money and stimulus that's out there seeking yield. We don't have a banking problem or a financial services background, a problem. We have really an economic problem with lack of workers, like lack of labor, and too much money in the system seeking yield, right? So I don't think we're gonna have an issue with, you know, banks seizing up and banks calling notes. What may happen over time is that banks seeing something that's got a 3 or a 4 or 5% yield, and over time they see like the economics change. They maybe call a note due because they could put the money back in play at a higher yield, you know, as interest rates go up. But certainly secondary, tertiary markets and longer term financing is always going to win the game. So Sam, talk to us a little bit about your structure, right? You mentioned the 900 units that are in the development process, the acquisitions. I also know you just bought into a single family company that's doing build to rent. And so how do you structure those deals with you, the GPs, the LPs, to kind of have a winning, kind of win-win-win scenario for everybody?
Yeah, it's a great question. And honestly, it's deal dependent. I've done almost every structure under the moon. We've done joint ventures where we bring 50% of the capital, our limited partner brings 50%, then we do the work. I've done syndications where it's 80-20 splits with no pref, 70-30 splits with a pref. We raised a fund for 25 million to start doing the single family and the single family build to rent. Right now we're looking at raising a multifamily fund, but so it just kind of depends on the deal. But I guess our bread and butter, and for most of the developments we have in our pipeline, are the standard syndications, the 70-30 split. On the development, sometimes we don't offer a pref just because the construction time takes 2-3 years, depending on if you have to go through planning and zoning, and we don't want to get behind the 8 ball with a 8% pref if we don't have cash flow for 3 years. But on acquisitions, we always offer a pref, and all of our investors at this point have been friends or referrals or business colleagues and acquaintances from a previous life. So they have this trust factor with us and they know us. So we've always had outside of the first raise, we've always had a really easy time raising money for capital.
How about those couple you just said you just exited? What were the structure of those and how'd you guys do on those deals?
Well, we've exited 4 over the last quarter, basically. 2 were joint ventures. One was actually an RV park. That kind of just fell into our lap. It was a creative financing deal where we did a lot development and the owner of the RV park wanted a lot. So we basically exchanged them a lot for the RV park and a little bit of cash. We exited at about a 46% IRR. We did a 48 unit townhome development. That was actually, we were able to structure the loan where we didn't have to bring significant amount of money. So we did 151% IRR. On a syndication that we sold last Friday, we did a 54% IRR. And then one we sold in December, we did a 36% IRR. And those 2 syndications had anywhere from 25 to 35 investors.
Nice. So the RV park, how did it fall in your lap? The reason why I'm curious is I have a campsite, right? I have a park model camper and a gorgeous spot on the lake. It's got this big tree in the front with the swing the kids go on, and doing a bunch of investments in the RV park as far as like another pool and another bar and all this kind of stuff. So I love the summers at the campsite of the RV park. So how did that thing fall in your lap? And is there anything that you learned from that was good or bad about RV parks going forward?
Yeah, well, it kind of just fell into our lap. Like I was saying, with the owner needed a lot to build a house, so we traded him. But there was a lot I learned from it because we self-manage. One of the things we learned is there isn't really any good property managers in that space. And that park was pretty small. It had 60 lots and a single family home and 1 mobile home. So we self-managed and it took up a lot of time. And it was outside 50 miles or so from Fort Worth, and it was near a lake and a park to go hiking and stuff. But the typical tenant was a longer term tenant, and there was just a lot of issues that arose that we weren't expecting, dealing with drugs and meth and cops being called, or us being called by the cops at 11, 2 in the morning, all these random times. So I don't think I'd do it again, but it was a good learning experience. We did well on the investment and were able to move on and kind of wash ourselves from that experience.
Yeah, wash the goo off.
Yeah.
The need for affordable housing, which we definitely need, right? And so you also are in the process of, you bought into a company that does single family build to rent. So just talk about that structure with our group. To kind of educate our audience a little bit about that. And why build to rent? Obviously, you and I are both bullish on the fact that we need a lot of affordable housing. So multifamily apartments, build to rent communities, affordable housing is there's the demand way exceeds the supply right now. So tell me about the structure. How are you guys going to make money with those types of communities? What size of the homes are that you're building, and what do you think they'll run for?
It was pretty much a perfect transition because the owner of the company, he's had the business for I think 20 years or so, and he started off building custom homes, and he's changed his business model to do spec homes, and he built all the apartments that I've developed, he's built at this point. So we have a great relationship, and he understands that side of the business. I understand the operations, running the management. And there's, like you said, there's just a massive demand. I know last year NAA said there was a 4.2 million unit shortage of apartments in the US by 2030. And I mean, we're in a prime location where everybody's moving to DFW. We usually build on the outskirts. So we aren't having to fight the Trammell Crows, the JPIs, those type of developers, but we can find our own niche and be very successful at it. And the costs have definitely changed over a couple of years. Like, we were importing a lot of our materials from China. And then when the trade wars happened in COVID, that slowed it down significantly. Like, we were building for 100, 120 a unit. Now we're probably closer to 140 to 160,000 a unit. And of course it varies on square feet, but I mean, we're selling some of our deals at 4 or 5 caps. I've heard some very prominent data analysts and speakers talk about build-to-rent communities selling at 2 and 3 caps. And I think it's just the wave of the future, because we are becoming a renter nation. When people, they graduate high school, graduate college, they want to live in an apartment, but once they have a family and they might not be able to afford a house, a lot of people are going to those build-to-rent communities because they are nicer than an apartment. It feels like you have your own house. A lot of the build-to-rent communities have pools, they have amenities that the apartments have, so it's kind of the best of both worlds. And it's the next phase before you can afford a house.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Yeah, you look at some of the economics right now between, number one is the flight from the urban core, right? Partially because of COVID. People realize they don't want to live in a small box apartment, in downtown DFW or downtown Austin, downtown Cleveland, downtown Columbus. That's number one, especially because some people are working from home. They want the extra space, the office, that kind of stuff. So the flight to the suburban apartment is big. That's number one. Number two, single family homes for sale, right? They grew by 16.1% year over year. The price. So if you had a $200,000 house that grew by 16%, that's 32 grand, right? So now that house is worth 232,000. And if you had X amount of dollars saved in order for your down payment, now you have to have that much more of a down payment to afford a much bigger home. So people are thinking, well, I don't have that kind of down payment, so I need to rent. And like you said, a lot of these communities that do offer the amenities where people can feel like they're at home, that's a big deal. And wage growth is up almost 5% year over year. And even though apartment rents are up about 15%, certainly wage growth is happening to allow people to afford those rents. And so for all of those reasons and the lack of supply, just general lack of supply, it's a winning strategy to build to rent, or it's a winning strategy to own value add apartments. It's going to be, we're very bullish on it. As a matter of fact, the largest apartment owner, one of the largest apartment owners in the country, is True America, right? And the CEO, I just listened to him talk, and he said, look, we're so bullish on apartments. We think the growth is going to continue unabated. And when I hear that, it scares the crap out of me. Yeah. And I also want to be bullish, but the word unabated, when I hear that, I'm like, ooh, man, I might be a little too bullish on it, but unabated is the word he used. So for you, Sam, what do you like this year and the next couple years? Are you kind of getting behind that same kind of drummer and following along? Or are you continuing to think, look, this thing's going to keep going?
I am very bullish on apartments and the housing market in general. I don't know if I'd go as strongly as say unabated,
Yeah.
but you mentioned earlier, I mean, this is a new frontier and we don't know exactly what's happening. The Fed and the other world governments printed more money in the last couple of years than they ever have. And everybody's searching yield. Like I've talked to investors in South Korea where they're happy with 2%. I've talked to investors in Europe where they're happy with 5%. And people complain about America, but we still have the strongest currency in the world and it's the safest place to invest. So with the amount of capital flowing into real estate, multifamily has been a very strong, if not the best asset class for 10 years going, or give and take a few years. So people are trying to get out of other asset classes, putting their money into safe, secure investments. Then with the supply issue and the pricing of your own personal residence skyrocketing, like you were just saying, I think it's almost a perfect storm for rentals, whether it's multifamily, build-to-rent, or just single family. If you aren't in multifamily, I would argue that single families or multifamily is a lot better way to invest, but people that enjoy single family are going to do just as well.
Yeah, no doubt. No doubt. I'm with you on all that, all those points. Great points. Sam, when you got started in this, there's probably about a third of our audience that are residential investors looking to scale into multifamily. So I'm curious to hear about your start, your first couple of deals. You mentioned that you were a limited partner in the first couple. And I'm just curious to hear about some of the initial challenges that you experienced and what you learned from them.
Yeah, I feel like every deal I've ever done has never went 100% to plan. So I've always learned something from them, but I invested as a limited partner in 2 apartments and 1 hotel deal. The hotel deal didn't get off the ground. It ended up in litigation that we're still in over many years. One of the multifamily deals, we kicked out the general partner. So there's just a lot that happened and transpired. So I was like, okay, I'm going to take, I guess, the bull by the horns. And I started investing in single family because at that time I didn't have the experience or really the money to invest in multifamily. So I did quite a few single family homes. I remember the first home I bought, the day before we closed, the contractor went in without me knowing and started busting up things. And like 2 days before that, I found out there was massive foundation issues and I was going to back out of the contract. But since he walked in and started renovating it, I had to close, but it turned out to be a phenomenal investment. And there's just a lot of different things and issues that I've learned over the years that have popped up in multifamily. Our first multifamily deal was a multi-use development. There was a lot of rain, so it pushed timelines back. We had to fire the GC. We had to get rid of the property manager during the lease up for basically money laundering. There was a lot of issues that happened, but if you're intelligent, if you make decisive decisions and move forward, you can still be successful.
Yeah, I love it. That's great advice. That's great advice. So Sam, as we kind of round third and head for home here, I guess if you had to look back at all the things you've accomplished, $200 million in assets under management, you've sold a number of your syndications, 1,000 units of multifamily. You're obviously in a great spot, and Texas is growing like crazy and will continue to grow. If you had to look back and say, like, man, I did a few things right and a few things wrong, what kind of advice would you give your younger former self about your path? What would you change? And also, what do you think you did right that you do all over again?
I think some of the things I did right was I've surrounded myself with good partners and good people. I've really, since an early age, I always tried to surround myself with solid people that I looked up to and respected, and they could add value to my life. Another thing is I've always been a big proponent of education, and multifamily is not rocket science, but there's a lot of moving pieces. And you do need to, especially if you're on the operator side. If you're on the capital raising side, it's a little bit different, but if you're operating an apartment and do from soup to nuts, you need to know especially if you're taking investors' money, you have a fiduciary responsibility to do your best. So you need to know it backwards and forwards. And I think I did a really good job educating myself. Now there's, I mean, podcasts just like yours, there's mentorships, there's a lot of different things. I think a couple of things I would do differently was I've always, I won't say I have analysis by paralysis, but I've always kind of been slow to just dive in. And like, I worked a corporate job for 12 years before I went off, even though we had quite a few projects going on. And I would have took the leap a lot faster, I think. And the other thing I probably would have done is surround myself with knowledgeable people. Like early on, I surround myself with some great people, but they really hadn't done it. And I think surround myself with people that have 2,000, 5,000, 10,000 units early on would have been very helpful, because the first 2 years I was looking for multifamily, I was kind of spinning my wheels because I was underwriting way too conservatively. But that was, I mean, back then people were saying the market was going to correct like 2008, and that was in 2014. So I was hesitant and scared, and maybe hindsight's 2020. And if the market would have corrected in 16, I would have been very, very grateful. But we've seen this massive run up where the deal we sold as a limited partner. We bought it for 17, sold it for 30. It's probably trading between 130 and 150 now. So there's just probably really 6 to 7 years I missed out on a lot of growth potential.
Yeah. Yeah. You know, I mean, getting out though, and taking some chips off the table versus no chips.
Yeah.
You know, I'd take that all day too. Right. I think that the lesson there probably is, look, there isn't a perfect time to buy or sell. It's impossible to time the market. It's impossible to figure out exactly when it's going to, kind of hit a ceiling and start going south. And usually that's when there are no buyers, when you realize that you hit the ceiling. And it's impossible to time the market. So the only solution to that is to invest for the long haul, right? That's really the only solution. Invest for the long term, invest for cash flow, take some chips off the table sometimes, stay liquid, a lot of dry powder. And that's the only way to get through it. That's really the only way. And I think that's a timeless lesson that all of our listeners can take away is, take some chips off the table, stay liquid, invest for the long term. The last thing I would say too, Sam, is look, this business really comes down to underwriting, right? You mentioned underwriting too conservatively, and I tend to do that too. And I have other operators that are really pushing the needle and being much more aggressive. But underwriting for your style is hugely important, because not only does that become essentially your private placement memorandum, it becomes your business plan. Then your property management company, your CapEx crew, the rest of your team can all get behind that, right? It all starts with the underwrite. And the most important part of the underwrite, if you want to drill down even further, is what's the future rent? What's the future blended rent? It's the number one metric in multifamily. Nobody has a crystal ball to say what that's going to be, but this is why you have to be well-read. You mentioned education. You got to have a great education and constantly be learning about your markets and your submarkets. Because if you can better pencil out what that future rent is going to be, and you can better pencil out the underwrite, then you could be the most aggressive in your offer, right?
Yeah,
it comes down to that. If you want to get in the dirt. I'm sorry, Sam, you were going to say?
I was just completely agreeing with that. And everybody has a different risk tolerance. And the last thing I want to do is tarnish my reputation or have a bad deal just to get into another deal. And we haven't grown or scaled as quickly as some people, and I'm completely fine with that, because we invest every single project we have, we invest money in it. And also every single investor that I've raised funds from, I have a personal relationship with. So I don't want to look them in the face and say, hey, we lost this much, or we only got 5% on your return, when yes, multifamily is a diversification strategy, but you're also competing against the stock market or other investors. And if you're providing a 5 or 8% IRR, they're going to go somewhere else.
Right.
They could easily go to the stock market and granted, you have fluctuations in the stock market, but over the last couple of years, before the last few months, the stock market was up. So I think it's very important to follow your instincts and your underwriting, I guess, tactics. And I mean, people I know firsthand are changing their underwriting just to get deals, and I'm not going to do that. And yeah, and like you were saying, you talk to the property manager, if you give them an unrealistic P&L or budget, it's going to be hard for them to meet it, and it's just going to be an uphill battle, and you're going to be constantly fighting and bickering, and it's not going to be a win-win situation for any party.
Yeah, I love it. I love it, Sam. That's great advice. Listen, man, as we wrap up here, let's finish with what we call the final five. Some quick answers, some quick questions. You ready for these?
Yes, I am.
All right. What's your favorite way to find deals in today's market?
In today's market, it's either going to brokers and relationships we have, even debt brokers, or going directly to the seller. The last 3 acquisitions we've done have been directly off market, and haven't had any competition, which has been great.
Nice. What's your favorite way to find capital for your capital stack and limited partners and mezz debt and just the whole stack?
At this point, going to the network we have and the referrals we have, one of my goals is to make as many millionaires as I possibly can. And I think by getting repeat investors, I can do that. And who better to do that than with your friends and family? Yeah,
I love it. Sam, what do you think is maybe your favorite book that you've read, or the favorite piece of advice that you've been given that, really kind of guides you on a day-to-day basis and really has an impact on your life?
Over the last few years, I've read a lot of books, so it's hard to narrow it down. But one that has changed my life, honestly, the last 6 months is Who Not How. And I've always been a person who just does, and I have a hard time delegating. And I finally realized I have to delegate or I'm going to die. And by delegating, I can focus on a lot more higher income activities and revenue generating activities.
Yeah, if you guys are not familiar, that book, Who Not How, I've read it. It's I can't remember the main author, but it's based off of Dan Sullivan, right? Strategic coach, who I've studied for over 20 years. And I highly recommend that book, especially for commercial investors and multifamily investors, because really in this business, it's about aggregating the best team. It's about aggregating the who. And then as a group, you'll figure out how, right? Versus most people think like, how am I going to do this? That book really pushes the theory of find the person who can do it, or who can bring you the answers instead of you figuring out how to do it yourself. It's a phenomenal book. I'm a huge fan of Dan Sullivan as well. Sam, who do you think's been the mentor that's had the biggest impact on your life? Like, who's been somebody that you've looked up to and that, you've kind of grabbed onto their, curtails, if you will, and kind of followed along?
From an early age, I would say it's been my grandpa. He was a successful businessman and also family man, but he always just pushed me to do more. He was a big proponent of education. And like anytime I had an idea or dream or goal, he was like, why not double it? Essentially, almost anytime I had a goal, he's like, why not do this or X or X? And it's just pushed me to achieve so much more than I ever thought possible.
That's fantastic. And Sam, last question about multifamily. What do you think is the biggest pothole or choke point for new investors? Like, what do you think is the one thing that they should look out for?
At this point, pricing is the highest it's ever been. And even though I'm bullish on it, we don't know what the market's going to do with the potential for interest rate hikes. So I'd say just be cautious on what you're buying, and long-term debt is key for uncertain times.
Yeah, that's fantastic stuff. Long-term debt, try to stay away from bridge and short-term capital. Definitely underwrite with these 4 interest rates hikes in mind, right? Because by the time you stabilize and by the time you're ready to refinance or sell, those are going to be part of the underwrite. It wouldn't surprise me, by the way, Sam, that if the Fed raises rates in the short run to tame inflation, and then they drop back down because there's just so much freaking money in the system, right?
I think they could easily do that. I know the T-bill went up this week, and they're projecting more interest rate hikes. But like you said, with the amount of money in the amount in the money supply, I don't see how they can keep raising rates, and I could easily see it drop back down after they raise it up some.
Yeah, same here. Sam, awesome stuff today. Thank you so much for joining us today on Accelerated Investor. If our audience wants to reach out to you, connect with you, invest in your deals, just learn more about your business, where can they go?
Yeah, you can go to my website, batescapitalgroup.com, or you can send an email to info@batescapital BuildtoRentGroup.com. I'm on social media sometimes. I'm not a huge, even though I'm a millennial, I'm not a huge proponent of it or adopter of it, but you can reach me there as well.
Fantastic stuff, Sam. Listen, thanks for joining us today on Accelerated Investor.
Josh, thank you for having me. It was awesome to talk to you.
Well, hey guys, I hope you enjoyed that episode of Accelerated Investor with me, Josh Cantwell, and Sam Bates. If you would be so kind, leave us a rating and review. Let us know if you enjoyed that interview. Reach out to Sam on his website. And also, if you're looking to take your investing to the next level, where you're an owner-operator, a residential investor, limited partner, go visit our main website, freelandventures.com. There you'll find everything to do with our mastermind, our investment opportunities, our portfolio. Check out freelandventures.com for all things Josh Cantwell and Freeland Ventures. Thanks so much for being here. We'll see you next time.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.